Surprise, 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 as Gomer Pyle used to say. For those of you that don't know who Gomer Pyle is, um, it'll be a nice subject over a meal with your folks next time you're able to get together. And if not, just Google it. Look, the Fed duped us all last week. They really did. Nobody expected them to not begin tapering of the $85 billion dollars a month mortgage bond buying program that they've been engaged in for some time now. But they decided to do nothing. The markets responded nicely. Um, I stated last month that hey, I'd really like to see them go ahead and make a decision on what they're going to do. Start tapering, and hopefully over on the Treasury side more than on the bond side to keep our housing recovery strong and keep the market strong and what we've been experiencing. I know a lot of you are experiencing a little bit of a drop in buyers. Inventories are on the rise a little bit right now, so people are feeling a little edgy. And I think it's just a short blip. I don't feel like from all the folks that I work with in a couple of different markets and in our markets as a national mortgage banker, we're seeing pockets that have stayed real strong, some pockets that have been affected a little bit more negatively. But there's no doubt that applications, that the rates have affected the buying level. So that is a real thing, and we've got to work through it and work harder at getting in front of clients on a more regular basis. Look, the markets really right now are just trying to reorganize after the little duping we had last week, and they started out confused, although the markets have reacted very positively in terms of pricing. Very impressively, this week the bond price was able to edge above the 100-day moving average. Ironically, that ceiling was set from Mr. Bernanke clear back in June when he made the rogue comments about the fact that the Fed was going to begin tapering immediately, and the markets responded so negatively and caused the real spike in interest rates that we all experienced this summer. But that has subsided. Now, rest assured that I assure you that the Fed still has Mr. Bernanke's finger firmly on the trigger, ready to pull back the tapering process sometime around the first of the year. Until then, we'll ride this thing out and we'll take what we can get, and like I say, hopefully have a nice little run here. Rates were at about 104.89 is the next ceiling of bond pricing that we have, and we got about a 50 basis points run to get there. And actually, the breakthrough has now provided us with a technical floor of support that will serve us well here in the short term. As far as programs are concerned, we have released a new ARM program this week. It is both for conforming and high balance loans, 5-1, 7-1s, and 10-1 ARMs. Very competitive rates. Can be coupled with secondary financing, so HELOCs, seconds, supportive to help folks when dealing with mortgage insurance, and there's things we can do there to keep payments very competitive and keep them out of the old MI world, if you will. These are again both for conforming and high balance. There are some little innuendos that work for each, and I'll be happy to share with you and your clients the great things about this program. The biggest thing is giving folks that are especially in a move-up market or maybe buying and dealing with the price increases and appreciation we're all experiencing, which while that's a great thing in many cases, it does a little bit of pressure on financing and pricing for some people and their income levels. So this program was designed to help mitigate those issues and get people into homes and help you close loans. We also have a new Cal HEFA and CHDAPA program that can be coupled with a couple of well, actually a couple of them. There's all kinds of down payment assistance programs that we can work with in conjunction with that program, and we can get as high as about 98, 99% loan to value, so darn near 100% financing in some of those programs. The really neat thing about those is some of them have no interest. They have forgiven interest. There's complete forgiveness of the debt over a period of time. So there's some really neat, unique things that we can couple together with those for first-time home buyers and help them get out of the rental market and into homes as the inventory increases. So and again, I had sent out a couple of notifications on our new FHA program where we're allowing 1 year seasoning only on foreclosures, bankruptcies, deed in lieu, and short sales. So look through your database, work your database, and I guarantee you're going to find some deals in there. The program has a lot of loopholes to jump through, but there are deals there, so jump through them. Again, a lot of these programs I can share with you in detail. I don't want to do that on this video. I try to keep this thing short. If you'd like to meet with me or your clients in person, I'd love to do that, and we can work our way through these in detail. If you'd like an overall view at one of your office meetings or your marketing meeting during the week, give my office a call and set up an appointment with one of my assistants, and we'll get a presentation into your office and help you guys close more transactions. The charts that I've referred to are now embedded into the video, so when I refer to charts, I'm trying to make this quick and not time, so I'm not putting them on the screen, but they are in the emails on the notification when these videos are available. Last bit of news this morning was the Case-Shiller Home Price Index came out. Was very, very encouraging. It showed homes appreciated at 12.4% year over year on a year-over-year basis. Keep in mind that's a July report. It's in the email that you can use as you choose. Also keep in mind that those most likely were contracted and consummated in May and June before the rate increase. So we'll keep an eye on what. At the same time, while they showed a little bit of reduction and deceleration in the market, the Federal Housing Finance FHFA came out and they showed their conforming mortgage home values increased 1% in July, which was another year 8.8%. So it contradicted her a little bit, which happens often. But one thing's for sure, forget about what the media is saying about this. They're focusing on Case-Shiller's deceleration as far as appreciation is concerned. There is a deceleration in appreciation is still appreciation. It's not depreciation. So don't get caught up in that. Let your client have a strong market and very competitive rates and some great programs that are helping offset any of the increases we've had. Hope you're enjoying these videos versus emails, and we'll talk to you soon. Bye-bye.